What's up, traders? Thank you so much for clicking on this video. I really do appreciate your time. I appreciate your support. Thank you all so very much. Go join our free Telegram group. We have nearly 50 traders in there, and we are expecting hundreds more soon. So the link is in the description below. Go join. It is free. Man, I've been having these dreams, bro, about this setup, the ICT market maker model silver bullet, right? It's like taking candy from a baby. But what if there's like a silver bullet within a silver bullet, if that makes sense? Let's go and back test it, bro. Let me show you how I back test. My bread and butter is the weekly time frame into the 4-hour Mmxm model. So we look for weekly internal range liquidity to external range liquidity. We figure out what is our next draw on liquidity, right? And so knowing that, we want to identify what got ran into most previously, right? So you can see there were these relative equal highs that this big green bullish candle on the weekly time frame expanded through, right? And so it provided a lot of direction because not only did it take out these relative equal highs, it also took out these bearish PDAs that, like, you could see price respected in the past. You see here with this bearish fair value gap, price traded into it and respected it previously in the past. And so with that, we now look and we see, all right, there is this internal range liquidity, right? Price just expanded past external range liquidity and even took out these highs over here. This is another form of external range liquidity right here that it expanded through. Right here is a form of internal range liquidity. And so on the weekly time frame, when price taps into either weekly internal range liquidity or external range liquidity, we drop to the 4-hour time frame and we anticipate a market maker model. If it's going up, it's going to be a market maker buy model. If it's going down, it's going to be a market maker sell model. So right here, we're going to anticipate a market maker buy model. And you could do this from the monthly to the daily. Monthly PDA. A PDA is a fair value gap, order block, mitigation block, things like that. You could go from a monthly to a daily, a weekly to a 4-hour, a daily to a 1 hour, a 4-hour to a 15-minute, so on and so forth. Price is all fractal. It all does the same thing on every single time frames, right? On the lower time frames, it could be a lot less, what's the word for it? Probable, or a lot less reliable, because big institutions, big hedge funds, the big whales in the trading game, they trade based off of these higher time frames. The higher time frames are what move the charts, if that makes sense. It's all an algorithm. But right here, we're going to drop to the 4-hour time frame. And at the first point of interest, right, this is where you look for the market maker model, okay? So the original consolidation happens right here at the very top of the market maker model. This is where price originally retraced from into that weekly PDA. And then you have a first accumulation and a second accumulation. You know, this could be like the first accumulation right here. And then you have the second accumulation right here. And then price finally dumps off into that PDA, okay? And so right here, you don't really need to worry about any of that, right? What you really want to focus on is, where does price show its hand? Where is that market structure shift? Okay. And the market structure shift is going to be like a price reversal. It's a change in the state of delivery. It's a smart money reversal. It's all pretty much the same in my eyes. Okay. Whenever you start trading these concepts over and over and you start putting them together, you start to realize that a lot of them are kind of similar in many ways. They just got different names, right? So right here, I'm looking for my most recent 3 candle wick swing high. That price closes over, disrespects, and then it like holds, you know what I mean? So right here, price closes over it, disrespects it, closes above it, retraces, right? And it retraces and it taps into this down close candle here. Or if you want like a bigger area of interest, you have this down close candle too, right? Price closed above them both. They both become somewhat of a order block PDA kind of thing, right? And price ends up having this expansion leg here. So in my eyes, the the MMXM trader, if you have him on X, I learned this from him, okay? So flowers to this dude. Right here, you can see this is the low risk buy. And it's not necessarily low risk for us, it's more of a higher risk because we don't know if this low is going to hold. This is more or so a low risk buy for like big institutions and hedge funds, because the MMXM model, it's a hedging system. So like what happens is these big institutions and hedge funds, they'll buy a little bit here and then price will send lower, and then they'll buy a little bit more and then price will send lower, and then they'll buy a little bit more. It's like dollar cost averaging in a way where they're getting better positions and better entries, and they're loading up more and more to then send price the other way and then mitigate out of their positions, if that makes sense. So right here, this is going to be the low risk buy right here for me. And then from that point, you can see that we have the next distribution leg right here. So we look for the next distribution leg, right? The next distribution leg up. So that's going to be this leg right here that creates up to this high, right? This is going to be the next distribution leg because it has this accumulation right here, right? From this high to this low, it accumulates, it engineers liquidity, sweeps out the low right here as well. And from there, it ends up distributing higher. It also has that turtle soup where it took out a low to the left of it, and it created an what is it? Intermediate term low. And that's what you want to look for. An intermediate term low, especially after like a turtle soup, price is not supposed to violate that low now if price is going higher. If price isn't going to go higher, it will violate that low. So that's how you'll know price is not ready to go up. And it doesn't violate that low. And I know we're doing this in hindsight. That's how I like to backtest, right? I apply these concepts to hindsight so I can see how price adapted and moved around them, because I can't necessarily journal emotions, how I'm feeling, because I see it. I see what happened. You know what I mean? That's where we take this hindsight back test and what we kind of built as far as intuition goes. We're building intuition and we're learning and seeing how price reacts and moves around these areas of sensitivity. And we're taking that and we're going to apply that to live markets. And that's where we live test, where we could journal our emotions and things like that, right? So, with all that being said, you can see from right here, this is going to be the first distribution leg right here up to this high. And then price comes back and it retraces. What does it retrace into? It taps into this internal range liquidity fair value gap right here. And this right here, because this is your intermediate term low that should not be violated, this becomes your silver bullet, especially because your original consolidation, which is going to be your actual external range liquidity target on that weekly time frame, this is your next draw on liquidity from here. And because we're so close to trading into that, this is why it becomes like taking candy from a baby. It's like we're so close to our next draw on liquidity that this is actually ridiculously, like, if it does not hit this next draw on liquidity, price is just stupid, bro. It's freaking stupid. You know what I mean? But bro, of course we're not going to have a 100% win rate with this, but this is like a holy grail because it's going to hit very, very, very often. Especially if you back test it, you're going to see it play out. So like if you took your position right here at that fair value gap, because this would be where price retraces, it retraces within this candle, taps into that fair value gap, and then you could put your stop loss right below that intermediate term low, because again, if price violates that intermediate term low, price should just continue going lower. It should not violate that. And then your next targets will not only be that external range liquidity, but this one right here too, because this was the previous distribution high right here, right? The first distribution high. But if you targeted that right there, that would be like a 1 to 4 R. Now, how could you turn this into like a silver bullet within a silver bullet, right? Well, like I said, if you go from like a 4 hour to a 15-minute market maker model, let's see that. Let's see what happens in this scenario, right? If we go back to that area, this is how I would look at it. So right here, you have this external range liquidity expansion, right? And this would become your low risk buy. And it holds right there. And it takes out this leg right here. And this is going to be like the first distribution high right here. And then for me, what I would like to see is right here, you can kind of ideologize. Is that even a word? Let's take that word out. Let's just not even say that that happened. Okay, that was weird. My brain just had a little like it just skirted a little bit, bro. Anyways, so right here I would say that this is my low risk buy. Okay, and what did it tap into? It tapped into that internal range liquidity. You want to wait for that low risk buy to happen so that way the market can show you its hand. It's showing you that price is likely going to continue in this direction. Okay, because like right here is that market structure shift, and then it retraces internal range liquidity, has that low risk buy, and then it has this pullback right here, taps into this down close candle, which is going to be a bullish order block, right? And this right here, I would consider it like a first stage of distribution. But again, like what we want to see is like an internal, like an intermediate term low that's created by a turtle soup, right? So what happens over here is we have this low right here that got violated, turtle soup, expansion, right? And then you have this right here. And this low right here, this is where we would enter. This low right here would confirm the intermediate term low because it doesn't have a swing low to the left of it yet. And you're looking at these 3 candle wick swing lows, by the way, right? You have these 3 candle wick swing lows right here, 3 candle wick swing lows right here, and then this 3 candle wick swing low right here. Price violates it, creates a lower low right here. So you have this short-term low, short-term low, and then once this one closes off of this candle, this confirms this short-term low, creating this into an intermediate term low, and price should not violate this. So if you took another entry off of that, this is like a silver bullet within a silver bullet, because again, this would be like the first stage of distribution for me, and then the second stage would be right here, and then this would be boom, or sorry, this would be the low risk buy, and then the first stage of distribution, and then the second stage of distribution right here, right? And even then, once this gets confirmed, once this candle closes right here and it confirms that intermediate term low, you can anticipate that to continue higher, right? But you would put your stop loss below there. And again, it's like taking candy from a baby, you know what I mean? You can just hold that for like a 1 to 2 if it's like a little less risk to reward. As far as holding it to here, you would get like half an hour or whatever, but you could hold it for a 1 to 2. Now let me kind of like just give you a little brain blast real quick, like a little, what is it, a brain fuck, if you will, where you're like, holy shit. So this is all kind of similar to, you know, this market maker model. If you're familiar with Romeo on, you know, Romeo CRT or whatever his name is. What is his name? Romeo TPT, where he teaches that CRT model and whatnot, that candle range theory stuff. Right here, candle range theory often happens at these internal range liquidities or external range liquidity PDAs. So like whenever price closes below it, not closes, sorry, whenever price wicks below it and then closes back above, you could say it happens over here too. It wicks above it and then closes back below it. You know what I mean? That Romeo teaches to look on the next candle to enter on the low of the next candle. Now that's like the power of 3. And this usually happens after, right, this candle closes, the previous candle closes within. Oftentimes that candle closes within and it does a market structure shift, smart money reversal. And then the next candle is just going to be a weekly power of 3 model, dude. And then it taps into 4-hour internal range liquidity or something, dude. And this would be a weekly power of 3. So you just turned a MMXM model, a 4-hour MMXM model off of weekly internal range liquidity. You identified a weekly CRT, a candle range theory, where the candle closed within the range. And whenever you drop to the 4-hour for that market maker model, that candle closing within the range is actually a 4-hour market structure shift. The next weekly candle that opens, you look for it to open on Sunday at 17. The open is right here. Now that the market structure has shifted on the 4-hour, your bias on the weekly time frame is now bullish, and your drawing liquidity becomes that weekly external range liquidity where the original consolidation started from. And from there, you're anticipating weekly up close candles. So you're going to look for the weekly open, low, and it's going to go low into a 4-hour PDA. And it goes low, taps into the internal range liquidity right there, and then it distributes because it opens, it accumulates, manipulates, creates the low of the week, and then it distributes throughout the rest of the week. Oh, holy freaking smokes, bro. Go back test that. The way you could back test it, say that your whatever your entry time frame is, say that your entry is on the 4-hour time frame, right? Like mine is, like I just showed you here. Go ahead and just go to that 4-hour time frame, go all the way back as far as you can. And this is good if you have the free trading view plan, right? You don't have to pay for trading view if you want to do this. So right here, you go as far back as you can where it says power up your plan, blah blah blah. Drop a little line right there, and that's as far as you could back test. Go to your weekly time frame, and from that line that you just placed, look for this setup, right? Let's say right here. Price had this expansion. I talk about adding that Fibonacci to identify your range and your discount price. And you can see there's this big gap in the market. ICT talked about this kind of gap as well. Boom, price taps into that. This becomes a 4-hour market maker sell model, right? But wait, if we look at that too, what also happened? You can see that we had this candle over here and this candle right here. That price wicked above and closed down within. Candle range theory right there, right? And it's happening at a weekly internal range liquidity PDA and whatnot. So now dropping down into the 4-hour, going back to that area, right? Let's see what happened. So this was the candle high, and then this candle closed within this one, right? And then the next candle wicked above both of them. And so when that happened, you're looking at that last 3 candle wick swing low, which was right here. And then price closed below it. That's going to be a market structure shift. It also closed below all these candles, these bullish fair value gaps, bullish PDAs. It closed below all of that, right? But again, this is going to be a low risk sell. It's actually higher risk for us because we're not necessarily certain if this big bullish fair value gap is going to hold and send price higher, right? So what we want to see is we want to first see the low risk sell, and then the distribution after that. We want to see the first stage of distribution, okay, after that. And then after that, we want to look for that second stage of distribution when it gets closer to that original consolidation. And that's where it's going to be like the silver bullet, taking candy from a baby. The low risk sell right here, right? Low risk sell. Because price market structure shifted and then it retraced and then it sold off from there. This would be the second, not the second, the first distribution right here. And on that first distribution, you can see it creates that short-term high, and then it creates this one right here. This would consider this an intermediate term high because the 3 candle wick swing high was lower to the right and the 3 candle wick swing high was lower to the left. This was the highest point, and that would make that the intermediate term high right there, right? And this would be our entry right here. As soon as price taps into that FVG, this would be the second stage of distribution. That would be your silver bullet. Stop loss would be above that intermediate term high because again, price should not violate that. And taking candy from a baby, we target those lows 1 to 2R. Boom. And you can see that we hit that. It's beautiful, bro. The probability on this is crazy. Let's see. On this time, Sunday, so after the market structure shift, once the candle closed within, the next candle opened right here. This was the next one. It opened high, manipulated high, and then it distributed off throughout the week. And then it retraced in the middle of the week, and that was our silver bullet entry on this weekly candle. So we got an open, high, low, and then it closed off down here, right here. And then the next candle, what we could have done is we could have scaled in on our entry opportunity potentially. However, it was the same entry in my opinion, but you can scale in. So like, again, we're anticipating weekly candles to be open, high, low, close. So this is the open of the week and it opens, it goes high. What does it go high into? That same PDA. And that's where you could have taken, you know, an entry if you didn't already take an entry off of this one. You know what I mean? Let's just say that we entered off of that one. Stop loss would go above that same intermediate term high over there. And then from here, that's where that distribution happens off in that weekly candle throughout the week, right? So again, I hope you got some value from this. This is the Mmxm model and the silver bullet CRT. You got the freaking all of that good stuff, bro. I hope you guys got some value. If you did, drop a like on this video. Comment if you want to see more like this. Let me know if you like this video. Comment, let me know. I appreciate y'all letting me know if it's a good video or not. And go join our Telegram group. It is free. We will see you guys in the next video. Later.